And the process ends only on the closing date, with the endorsement of the shares or quotas and the simultaneous transfer of funds, once all the necessary authorizations have been obtained. If the exit strategy involves an IPO, the stock market is the buyer of the funds holding. The IPOs put in place by private equity entities certainly have an advantage in terms of certification effect, knowledge of the markets and credibility of the assignors, but they are also subject to the contingent conditions of the capital markets and do not present the same degree of attractiveness and feasibility. This sales channel requires specific qualitative characteristics, for example organization, transparency, reporting and dialogue with the market, from the companies that are going to be listed, as well as quantitative characteristics such as size, profit margins and income prospects. From a geographical point of view, it is emphasized that they are more frequent, as exits of financial investors, in Anglo-Saxon markets than in Southern Europe. Sometimes, especially in majority transactions, the IPO allows the selling financial investor only a partial divestment, with relative advantages and disadvantages. Among the advantages, those of retaining a part of the upside linked to the appreciation of the stock market. Among the disadvantages, those of postponing the monetization of a part of the investment, with the risk of not keeping the price obtained during the IPO. This valorization opportunity for the exit of financial investors, the IPO remains, in order of importance, only the third option after the trade sale and the secondary buyout, both for the eligibility requirements that only a minority of the companies in the portfolio can represent and for the frequent objective of the transferors to implement a total disinvestment of the shareholding. The IPO involves an absolutely different and more regulated process than the M&A, with lower degrees of flexibility, a series of standard features and a well-defined authorization process. The duration of the preparation phase varies greatly from company to company, and at the end of it the target must present certain requirements in terms of governance, management control and adoption of accounting principles. It is known that many companies are more ready than others to face the stock market, and the decision of the private equity investor to implement an exit through IPO will depend on an objective diagnosis on the degree of the actual preparation and suitability of the company and of the management for landing on the markets. In this regard, the possibility of implementing a dual track in which a listing process and an M&A process coexist is emphasized. The choice of the double track arises, in addition to the need to maximize the price, from the need to reduce the risk of execution and final pricing inherent in stock exchange listing projects, generally more exposed to exogenous factors and sudden changes in the market mood. Note how, although the processes are completely different in terms of structure and interlocutors, they can be reconciled from a timing point of view and benefit from each other, also because the huge processing of historical and prospective data carried out by the company creates in both cases a useful information base.